Welcome to Business Chronicles. I am Pallavi Agnihotri.
I am Sebastian Arwan.
In today's episode, we will have an in-depth interview with Mr. Girish Chandra Bhatt, Chief Manager of Life Insurance Corporation of India,
Followed by the important tax deadline for the month of June, presented by Vince Rangasamy, tax analyst at Rogers Capital Tax.
And in the last segment, we are going to have an in-depth discussion of a recent judgment, namely the Dilu case, with Mr. Ryan Alas, the Managing Director of Rogers Capital Tax.
Let's now delve into the first part of our show. It's a pleasure to welcome you today, Mr. Bhatt, for this new episode of Business Chronicles. So, as an expert in the field of insurance, can you explain the importance of life insurance and its role in financial planning, especially in the context of the Indian market?
Thank you for having me on your show. Life insurance is an important tool for providing family protection to the family. A family is generally dependent for its financial needs, including the basic needs of food, clothing, and shelter, on the primary earner's income. As long as the primary earner is alive and earning, the family enjoys a stable financial situation. However, if suddenly death takes away this person, then the family may face a severe financial difficulty. Death is certain, but yes, its time is uncertain. So this uncertainty of death poses a substantial risk to the financial well-being of the family. This uncertainty requires some sort of coverage safeguard against the potential financial hardship that the family may have to face on the death of the breadwinner. So life insurance mitigates this risk by providing a measure of safety, security, certainty, and financial protection. It guarantees that a certain sum of money would be paid to the beneficiary on the death of the life assured. The life insurance proceeds can be used for meeting living expenses of the beneficiary, educational expenses, outstanding debt, and other financial needs of the family, thereby maintaining the standard of living of the family. The life insurance proceeds also give crucial time to the family to adjust to the new changed circumstances without facing much of immediate financial difficulty, and if necessary, find out and establish a new source of income. Right? This is so more critical in India, where most of the families don't have enough savings or assets outside the primary earner's income. The social security schemes in India also does not provide enough coverage to the family in case of death of the breadwinner. So it becomes more important for an individual to have self-initiated life insurance coverage to provide financial protection to the family in case of an unforeseen event. Life insurance is not only about shielding against risk. It can be used for children's educations, children's marriage, for retirement funding, for wealth creation, wealth transfer, estate planning, for financial protection against major illnesses, major disease. In India, it also aids in income tax savings. So having life insurance is provide ultimate peace of mind. So integrating life insurance into your financial planning is not only wise, but it's very crucial for your financial well-being in the long run. There are various kinds of life insurance products like term insurance plan, endowment plan, whole life insurance plan, unit-linked insurance policies, money-back policies. So we can choose any product as per our need, preference, and lifestyle. But yes, any earning member must, whether is Mauritian, Indian, or otherwise, must invest in life insurance policies to provide financial protection to the family.
So, Mr. Bhatt, you just mentioned about wealth transfer, estate planning. So, what role does life insurance play in estate planning and wealth transfer, particularly for high net worth individuals?
Estate planning is a critical aspect of financial management that ensures smooth and efficient transfer of your assets to your intended beneficiaries on your death. For high net worth individuals, life insurance can play a vital role in wealth transfer and estate planning. It ensures smooth and efficient transfer of your assets to your heirs, offering several advantages. The life insurance proceeds which you receive can be utilized for meeting final expenses of the deceased, like hospital bills, funeral expenses. It can be used to meet living expenses of the beneficiaries. It can be used to pay estate taxes. It can be used to pay outstanding debt and other financial obligations of the family. There is no need to liquidate any illiquid asset hastily. The life insurance products are easily and quickly accessible to the beneficiaries without any need of probate process, which may be time-consuming and costly affair. The life insurance proceeds are also tax-free in the hands of the beneficiaries, whereas other class of assets like estate may attract tax and other cost on transfer. For business owners, life insurance can be utilized as an essential tool in their business continuity plan. The life insurance proceeds can be used to efficiently transfer business ownership without disrupting the business operations. Life insurance can be used in equalization inheritances among your beneficiaries without having any conflict among the family or ensuring fair distribution. It helps in ensuring fair transfer to your family members. For an example, you own a house and you have two sons. You want your family should own the house, and one of your son is interested in keeping the house and other one is not interested. What do? You buy a life insurance policy of the value of the house and nominate your other son, disinterested son, as the beneficiary. So on your death, one of your son gets the house and the other son gets the life insurance policy as the beneficiaries, right? So you avoid any future potential conflict. You ensure fair distribution, and your wish that your house should be with the family is also met. Life insurance proceeds are very flexible and give you full control. Anytime you can change your beneficiary, you can increase your sum assured, so you can keep your estate planning aligned to your wish, right? If you have a dependent with special needs, then you can buy a life insurance and form a trust so that once you are gone, the needs of the dependent are met even when you are gone.
And with the increasing popularity of investment-linked insurance products, what are the benefits and risks associated in such policies?
The investment-linked insurance products are basically a combination of insurance and investment options, right? The premium which you pay, a part of it goes to insurance and the remaining amount is invested in the funds. The fund can be an equity fund, debt fund, mixed fund, or a balanced fund. You choose your fund based on your risk appetite and your investment strategy. One of the basic advantages is that it has a potential of earning higher returns. In traditional plan, what happens? The funds are invested in the participating fund of the insurer as per the investment strategy of the insurer. So the returns are not very attractive. Here the funds are invested directly into the financial market. If the funds perform, if it's well managed, if the funds are well managed and you use various options like switching, etc., then it has a potential of earning much better return than what the traditional plan earns. The investment-linked insurance products are very transparent. The various benefits and the various charges which you have to pay are outlined beforehand. You know what are the different charges you are going to pay. The investment-linked products give an option to top up and partial withdraw. If your investment strategy demands that you should add more funds, you should invest more, or you want to withdraw your fund, so the facility is there. You can invest more funds or you can partially withdraw also. The investment-linked insurance products also gives an option of switching of the funds. As I said earlier, there are various sub-funds like equity fund, debt fund, balanced fund, mixed fund. If you feel that a particular fund is not performing, if you want to generate better returns, if you want to switch, then you can utilize the switching option from one fund to the another fund. So every insurer allows some switches per month free of charge. So that is a very good option. Then the life insurance element here in investment-linked insurance product work like a term plan. So if you are young, the insurance charges will be very low for you, right? The insurance-linked investment products are very flexible. After a certain period of time from the inception, you can withdraw from the plan, you can surrender your policy at any time. As I said, along with the benefits, there are some inherent risks to it. The first risk I would say is the returns are not guaranteed. Since the investments are done in the financial market, it is exposed to the financial investment risk as well. The downside is not guaranteed at all. Okay, it can go whatever market is going down or whatever the investment fund is performing. So the returns are not guaranteed. This is the foremost risk. The other is that the product is very complex. As I said, the same product is giving you insurance and investment as well. So it's maybe some more difficult for new customer to understand. And then there are various charges to it. Some may find it very difficult to understand why so much of charges are there. And then you have to you have to track the performance of your fund, right? You have to utilize the switching options. If you don't utilize the switching options and you don't track your fund performance, then you may not be able to generate good returns, right? If someone is investing in ILP for a short-term time horizon, then it is not very advisable. Why? Because there are so many charges to the fund. And initial period, these charges are very high, like policy administration charges, fund management charges, selling charges. If you stay for a longer period in the term, these charges have a lower impact on it. So it's able to generate a better return. then there is a lock-in period in this investment products. Though you can surrender it after a certain period of time, but before that, there are either you are not allowed to surrender or there are some surrender charges before the surrender for surrendering the policy.
So AI is rapidly changing many industries, including the insurance industry. How would you describe the current state of AI in the insurance sector? And how do you see AI evolving the insurance sector over the next 5-10 years?
AI technology is already impacting the insurance industry by improving operational efficiency, personalizing customer experiences, and refining risk assessment. It is currently used in underwriting, claims processing, fraud detection, and customer service. Many insurers are using virtual assistant like chatbots for better customer experiences. Chatbots are available 24/7 to give basic advice and to address common queries and transactions. In next 5-10 years, if you ask, the role of AI is going to expand only. Maybe more sophisticated predictive models for underwriting and pricings will be there. AI will further impact underwriting, claims processing, customer service. Customers have different needs, preferences, and lifestyles. They expect personalized policies, loyalty programs, and recommendations based on their preferences and lifestyle. So AI-generated programs will help in giving the personalized advices to them. These chatbots will be able to handle more complex queries. There will be voice bots in regional languages will be able to give more personalized services to the customers. The response time will improve quite a lot. The responses will be quite fast. The processes will improve a lot. The acquisition cost of the new customer is substantially higher in the insurance industry than in any other industry, right? It is better to retain the existing customer. It is more cost effective. However, it is very difficult to find out when the existing customer is going to churn out. This AI-assisted programs will make it easy for us to identify, to predict when a customer is going to churn out. So the insurance companies take proactive actions, proactive measures to retain those clients by offering them loyalty programs or by engaging with the customers. With AI, the possibilities are boundless. We would start seeing this improvement maybe next 5-10 years, as you said. Customers may enjoy a more seamless user experience and more affordable premium rates. For insurance companies, by automation and improving their processes, they will all be able to save on cost.
And Mr. Bhatt, are there any tax implications associated with life insurance policies? If so, what are the potential tax consequences for policyholders and beneficiaries?
Life insurance policies in India allow for tax benefits under Income Tax Act 1961. These tax benefits are categorized into two parts. One is tax reduction and the other is tax exemptions. The premium which you pay for yourself, your spouse, and children are allowed to be reduced from your gross total income under Section 80C of Income Tax Act 1961. The maximum cap of this reduction is 150,000 each year. The other part is exemptions, right? So the proceeds which you receive from life insurance policies are exempted from including in your gross total income under Section 1010D of the Income Tax Act. So when you buy a life insurance policy, at every stage you are saving tax. Like at entry stage, when you buy a life insurance policy, you pay a premium for yourself, your spouse, or your children. You are able to reduce those premiums for your gross total income up to 150,000, as I said. When the fund grows, at the growing stage, the investment is definitely growing every year. So that growth is also tax-free. At the exit stage, when you receive the funds, the proceeds are also allowed to be exempted from including in your gross total income. There is one restriction is there that if you have invested after 1st April 2012, then the premium should not be more than 10% of the sum assured. Or however, if you have you have invested in life insurance policy before that, then it should not be more than 20% of sum assured. In Mauritius, if we say tax deductions are not allowed, but yes, tax exemptions are there. The investment which grow is tax exempted, and similarly, the proceeds which we receive are also tax exempted.
So, can you provide our viewers with some insights into the future trends and innovations we can expect to see in the life insurance sector, both in India and globally?
Yes, the life insurance sector in India and globally is likely to see more digitization and adoption of technology. Expect trends such as personalized insurance product based on customized on individual lifestyle preferences and choices. Greater use of AI and machine learning for risk assessment, underwriting, pricing, claims processing, customer service, and distribution as well. The goal for an insurer is to increase their revenue and minimize on cost. So they will be able to improve their efficiencies. They will be able to automate some processes and will be able to save on cost. Wearable technologies could be used more broadly to monitor health indicators in real time, providing data to be used for pricing of especially high-risk client based on the health indicators, health conditions. Automation of processes, access to data in AI-assisted programs will enhance fraud detection, especially fraudulent claims, reducing leakages of profits. AI will take over most manual processes, replacing human intervention in quoting, distribution, underwriting, and claims. Everything will happen much faster. AI and its related technologies will profoundly transform all aspects of insurance industries. Currently, we are selling insurance through distribution channel. The distribution channels will also go a lot of change. Like insurance will be bought directly from insurers' website, portals, or apps. The customers may get some discount on buying directly also, and it will be very easy for them also through AI-assisted programs to complete the formalities of buying a new insurance. Underwriting is an essential part of insurance through which insurers assess risk and determine premiums to accept it. Manual underwriting is time-consuming, prone to errors, so it will be replaced by AI-assisted underwriting. Customer service, as I already told you, that there will be customer virtual assistants, chatbots will be there, voice bots will be there. So they will enhance the customer experience and will be able to give personalized services to the clients, customers. Claim process will improve. It will be very fast. Artificial intelligence will strengthen the regulatory compliance and AML and CFT efforts by employing advanced data analysis techniques to identify suspicious activities. Transaction monitoring, ongoing monitoring will be much easy. KYC, CDTT, through the help of artificial intelligence will be very easy. These trends, driven by digital transformation, will enhance efficiency, innovation, customer satisfaction, making life insurance more accessible and tailored to individual needs. Both global and Indian markets will benefit from a more modern, responsive, and customer-focused approach to insurance.
Mr. Bhatt, thank you for this insightful discussion, and it was a pleasure to meet you today.
Yeah, pleasure was mine.
Thank you, Mr.
Thank
Bhatt.
you. Thank you.
Let's now move on to the next segment of our show, the important tax deadlines for the month of June.
Welcome to Business Chronicles. Let's dive into the important filing deadlines for the upcoming month. Mark your calendars for Wednesday, 26 June 2024. Electronic submission of APS for the quarter ending 31 March 2024. Electronic submission of return and payment of tax by companies with accounting year ending in December 2023. Electronic submission of VAT return and payment of tax liability for May 2024. Electronic submission of monthly return of TDS and payment of tax deducted for May 2024. Electronic submission of joint PAYE and social contribution, CSG, NSF return and payment of tax withheld for May 2024. Electronic submission of PRGF return and payment of PRGF contributions for May 2024. That wraps up our segment on important tax deadlines for this month. Stay tuned to Business Chronicles for more essential insights into navigating the complex world of taxation. Until next time, stay informed and stay compliant.
Hi, Ryan.
Hi, Ryan.
Hi, Pallavi and Sebastian.
How are you doing today?
I'm fine, very well.
Thank you for being with us, and you will talk to us about a recent judgment of the Supreme Court, namely Mauritius Revenue Authority versus DILU. So can you tell us more about what is known as the DILU case and its significance?
Okay. The DILU case involved a Mauritian national who worked in Saudi Arabia for a number of years and then moved to Canada. While in Saudi Arabia, he transferred some of his savings to Mauritius. The Supreme Court has ruled that a non-resident is only taxable on income derived from Mauritius. So if you are not resident in Mauritius, you will not be taxed on foreign source income. The Supreme Court comes to clarify this issue, which was put in doubt after the judgment of the ARC in the Didu case. However, a resident of Mauritius is taxable on both Mauritian source income and foreign source income transferred or remitted to Mauritius. The case confirms that income derived from abroad retain its nature when it is transferred to Mauritius, and it will be taxed in the year it is transferred. Practically, what does it mean? That Mr. Dilu was deriving employment income for a number of years in Saudi Arabia. He accumulated the income in his bank account and then transferred part of that to Mauritius. He argued in front of the ARC that this was not transfer of income but capital savings, contrary to what was an understanding in the tax practice before. The ARC said that it is income. It keeps its nature, and therefore the Supreme Court also confirms the judgment of the ARC.
So, Ryan, what does the Supreme Court's judgment say about the residency status of Mauritian nationals?
In fact, the Supreme Court judgment states that a Mauritian national will be considered a resident of Mauritius, irrespective of the number of days spent in that income year in Mauritius, unless they can prove that their permanent place of abode is outside Mauritius. This is not straightforward, especially if there is no treaty between Mauritius and the foreign country. Therefore, Mauritians working abroad need to be careful when remitting money to Mauritius for investment or savings. There is an interesting article that has been written by the former Commissioner of Income Tax, Mr. Mosafir, and which was also Director of International Tax at the MRA, on a recent tax ruling issued by the MRA, TR 264, where despite that the Mauritian national in that case moved to Singapore and had bought a home there, considered that its place of abode was in Singapore, despite that there was a treaty, the MRA still considered that the person is resident in Mauritius.
And so how does this judgment impact Mauritians nationals abroad?
In fact, this judgment means that Mauritians working abroad who transfer their savings back to Mauritius could be taxed on that money as income in the year the savings is transferred to Mauritius. Otherwise, they need to prove that the money is of a capital nature to avoid being taxed. For example, if it's money they derive from sale of investment or sale of an apartment in a foreign country, then it will be considered as capital gain, it will not be taxed. But the onus rests on the taxpayer to ensure that they can prove it's not in the nature of income. If it's in the nature of income, they can of course claim a foreign tax credit, but they must provide sufficient documentary evidence of the foreign tax paid. So the Mauritian national can be transferring the money after 5 years, and he may not have kept the evidence of foreign tax suffered 5 years ago. So it is very important. And this ruling could also apply to returning residents who get a tax exemption when they come to Mauritius. But the tax exemption is related only to the work that they will be doing when they come to Mauritius as a returning resident. So the foreign income accumulated abroad which is transferred may be taxed by the MRA as well.
Ryan, can you tell our viewers what changes do you think should be made to the current tax system to address these issues?
Yeah. In fact, for a number of years I have been calling for this change, and we will have the budget very soon. So I'm making a special appeal to the Minister of Finance to eliminate the concepts of remittance basis of taxation. We need to encourage the Mauritian diaspora and Mauritian working abroad to invest in Mauritius, to repatriate their saving in Mauritius. The current system discourages them from keeping their money in Mauritius. It would be beneficial to know how much revenue the MRA collect from individuals remitting foreign source income in Mauritius. I don't think it should be too much, because it's so easy to avoid. You just have to keep your money outside Mauritius. So even expatriates who come to work in Mauritius, when they tell me they have investment in various countries, I must, as a tax advisor, I must unfortunately tell them, keep the money in a foreign bank account, do not bring it to Mauritius, otherwise it will be taxed in Mauritius, or you will need to look for foreign tax evidence, etc.
Why is the remittance basis of taxation a problem for Mauritian nationals?
The remittance basis of taxation discourage Mauritians working abroad from bringing their savings back to Mauritius. They might prefer to keep their money outside Mauritius, so it is not taxed, or it's taxed only in the foreign country. And we know that in Mauritius we have a lot of expatriates. You can see when you go to near Western Union, you will see expatriates sending their money back to their country. But in Mauritius, what we are doing, we are encouraging our citizens who are working abroad, our Mauritian diaspora, to keep their money abroad when we need foreign currency in Mauritius. So I hope that there would be good news in the upcoming budget.
Let's hope so.
Thank you, Ryan,
Thank
for
you.
such an insightful analysis of the Dilu case, and we look forward to discussing more interesting cases.
Thank you.
Thank you.
We have now come to the end of today's episode of Business Chronicles. See you in the next one.